What basic cover misses on construction sites. Discover why EAR and CAR should be in every contract. Hi, namaste.
Hello, welcome to another episode.
So today we are looking at delays on construction projects,
Mhm.
from a slipped lift to a failed test, and how erection all risk and contractors all risk can turn setbacks into managed events.
Yes, to start off, think of a live site crews on the slab, cranes in the air, testing around the corner. One small incident can stop work and move dates, money, and confidence.
Timelines matter
Mhm.
because many projects are tied to festive openings, year end commissioning, or government deadlines.
True.
Slip a week and penalties start. Cash flow tightens and investors get nervous.
Yeah, the triggers are often ordinary.
Mhm.
For instance, a lift hesitates, or rain weakens temporary works, or maybe a vibration during installation pushes a unit out of tolerance. Nothing dramatic or extremely major, but enough to stall a site.
Yes, many contractors still rely on basic property insurance
Mhm.
that helps with fire or theft. It does not deal well with the realities of a working site, which is why two covers matter the most in such situations.
Yes, we are talking about Erection All Risk, or EAR, and Contractors All Risk, or CAR. EAR protects plant and machinery while they are unloaded, lifted, installed, tested, and commissioned, whereas CAR protects the civil works from site start to handover and includes third party liability for injury or damage to others.
That is why we look at two covers that belong on construction jobs during installation: Erection All Risk, or EAR, and Contractors All Risk, or CAR. EAR protects plant and machinery while they are unloaded, lifted, installed, tested, and commissioned. CAR protects the civil works from site start to handover and carries third party liability for injury or damage to others.
So basically, think of EAR as the safety net when you move heavy equipment into place and switch it on for the first time, and CAR as the shield for the structure and the people around it. For instance, a thermal power project in central India was at the final lift. A crane malfunction led to a sling slip, and consequently, the turbine was damaged. The
Mhm.
crane stood idle, and repairs took months.
In this case, EAR paid for the insured repair and reinstatement. That protected working capital and helped the site restart.
Also, this led to a substantial delay.
Hmm.
The owner could not commission on the planned date. Luckily, delay in startup, or DSU, had been added to the EAR. So DSU covered the loss of income from the late start, within limits, and after the waiting period.
Now, what's important to note here is that DSU does not pay on day one.
Hmm.
First, the physical damage is fixed under EAR. Then, after the plant restarts, the insurer compares what the project actually earned with what it should reasonably have earned if there had been no loss. That
Hmm.
assessment uses schedules and accounts, sometimes over several months, in some cases up to a year.
So, to summarize that, EAR sorts the repair.
Mhm.
DSU only comes in if the delay hurts income or triggers strict penalties.
Yes.
That is why we keep DSU as a specific add on, not the headline.
Now, when we look at CAR, it solves a completely different pain point. So we've all seen it. Indian projects run next to traffic, shops, and housing.
Hmm.
If an object leaves the site and hurts the passerby, a property policy will not respond.
Yes, and this is where CAR becomes so critical because it includes third party liability for such events within limits and conditions. That keeps a safety incident from becoming a long legal fight that stalls the build.
And today, most legal contracts make this a necessity. Owners and lenders often want proof of EAR or CAR before mobilization. Without it, advances and site access can wait.
Mhm.
So, insurance is not just a document, it is a control that unlocks the start and assures partners.
In such situations, usually a loss does two things. It breaks something you must fix, And it also burns time.
Yes.
Crews wait,
Yeah.
equipment is rehired, suppliers are pushed out, liquidated damages can start. When EAR or CAR pays for insured reinstatement, you take the first shock off the balance sheet. That gives you room to reset the plan.
Yes. Start with a simple question. Where does the risk sit this month? If you are moving heavy equipment, EAR should lead.
True.
If you are building a structure, CAR should lead. Many projects need a combination of both at different phases.
Once you have that in place, get the roles clear in the contract. Who is insured, who pays the premium, and who controls claims. Flow the same duties to key subcontractors, so there are no gaps when a crisis arises.
And also, ensure real values.
True.
Some insured should reflect the full cost to put the project back, not just the invoice price. Include freight, duties, and erection costs where they apply. If prices are rising, allow for escalation.
Absolutely. Next, set third party limits to the site.
Mhm.
For example, dense streets and highway interfaces usually need higher limits.
Yes.
Keep deductibles at a level your cash flow can carry, so the policy helps when you need it.
Yes. Define testing and commissioning in writing. When does testing start? How long does it last? When do you expect revenue to begin? Clarity here avoids debates at the first run and supports any DSU you choose to add.
Yes, in all of this, we must not forget that documentation is the quiet hero. It is extremely important to have lift plans, method statements, inspection records, and photos. If something happens, make the area safe, prevent further damage, and notify the insurer with facts and a simple timeline because good evidence speeds decisions.
Yes. Now, this reminds me of another case.
Mhm.
So, a few years ago, a metro rail extension was installing complex electrical and signaling systems. During testing, a critical unit short circuited and replacement pushed the program back by 6 weeks.
Oh, that's a major setback.
Exactly. But thankfully, EAR paid for the replacement unit and related reinstatement. DSU covered the authority's revenue gap because trains could not run on the planned date. Again, not instant. The DSU part followed restart and a measured comparison of expected income with actual income over the agreed period and after the waiting period.
That's great. I would say the key win in this case was not only the money, it was the calm.
Yes.
A complicated dispute became a process because they had the right cover in place at the right time.
Yes. And if you are still thinking how you can protect your site, here's a simple path.
Mhm.
Decide whether the next month is about lifts and tests or about structure and public interface.
Okay.
Place EAR or CAR to match that reality.
Mhm.
Add DSU only if a late opening would hit income or penalties.
Then set the numbers to reality. Full reinstatement on EAR, practical third party limits on CAR, deductibles that fit your cash flow.
And finally, write it down and keep records. Put testing and handover into the contract pack.
Sure.
Keep site diaries from day one. If something goes wrong, you will not be rebuilding the story from memory.
The message is simple. EAR and CAR are not just boxes to tick. They are tools that keep delivery steady when ordinary things go wrong.
Speak with our experts by logging on to www.mahindrainsurancebrokers.com to understand how EAR and CAR can save your projects, your relationships, and your reputation.
Absolutely. That's all for today's episode.
See you next time. Goodbye.
Bye bye.